Very good morning, friends. So I hope you made a revision of what we covered in the previous session on financial instruments. So just to remind you, we had covered the aspect of Index 32, outlining the three-step model with the help of which you identify from the issuer perspective, is that a financial liability or is it equity instrument or a compound financial instrument? Then we went ahead and understood and made a revision in terms of the split accounting applicable to a compound financial instruments. And we dealt with two special issues relating to a CFI. The treatment of transaction cost, as well as if there is an early redemption in terms of compound financial instrument. I think that becomes a core focus in terms of Index 32. Then we started our inputs in terms of Index 109, where I gave you the insights from the holder's perspective. What are the three steps with the help of which we identify and classify the financial assets into, you can say, two broad categories. One is called a debt investments. One is called an equity investments. The debt investments, depending upon a business model, would be classified under three accounting categories: amortized cost, and then fair value through OCI, which is recycling, and there is a fair value through profit and loss. Remember, in terms of debt investments, it is always a case of FPT OCI, that is R. And the equity investments were divided in terms of two broad categories. One is fair value through other comprehensive income, and that is no recycling. Equity investments is always with an NR. And the other category, FPTPL. We saw all the permutations, combinations, and made a comprehensive chart in terms of financial assets, where I think the key insights were typically understanding the treatment of a transaction cost, the initial measurement, where the TC is added or where the TC is not added. Typically, in terms of FPTPL, it is expensed off. Where does the concept of EIR applies? What is the treatment of unrealized gains and losses in each of these categories? What is the treatment of realized gains and losses in each of these categories? Which categories do we conduct in impairment testing? So I think three crucial points which you should always keep in mind is, when you look at the concept of EIR, it applies to debt investments and not equity investments. The concept of EIR, even in terms of debt investments, does not apply when it is measured at FPTPL. And then we understood the concept that impairment is applicable to debt investments, not equity investments. And that also only in terms of EC as well as FPT OCI. Whenever you consider a security at FPTPL, whether it's debt or it's equity, the concept of impairment is not applicable. So we made a comprehensive chart, understanding the nitty-gritties in terms of financial assets from an initial to subsequent measurement. Now, before I go forward and make a mind map in terms of financial liability, I think let's do one or two very interesting questions which are there in the RTP, which blends the concept of Index 21 as well as Index 109. Because then once the element of foreign currency comes into play, the question gets a little more interesting. So I'm going to do first of all two questions on the category of Index 109 merged with Index 21, that is foreign exchange. Then we'll move forward to the financial liabilities, which is easy because once you know the accounting for financial assets, getting the accounting for financial liabilities is not a big deal, because the concept of amortized cost in financial assets and in terms of financial liabilities is exactly a mirror image in terms of both of them. So let's, I think, first begin with you on a question on the area. Let me share it on the screen. So I'm just going to share a question to you on the screen. So let's have a look out here. So I'm reading the question number 6. It says, on 1st April X1, M raised a long-term loan from foreign investors. Now, this is supposed to be a case of a financial liability. Though I know I've not made the summary of financial liability, but as I said, you know the concept of amortized cost. It's a mirror image in terms of financial asset. So it says M raised a long-term loan from foreign investor. The investor subscribed for 6 million foreign currency loan notes at par. It incurred incremental issue cost of 2 lakh. Interest, it says, is 6 lakh and is payable on 31st March starting from March X2. The loan is repayable in foreign currency on March X7 at a premium, and the EIR, the effective interest rate implicit, is given 12%. The appropriate measurement basis for this loan is amortized cost. Very clearly, the category at which accounting is done is given. The exchange rates at the beginning on 1st April X1 is defined. And we're also given the year-end exchange rate as well as the average rate. The functional currency of the group is supposed to be Indian rupee. What is the appropriate accounting treatment for the foreign currency loan in the books of the company for the year X1, X2? Calculate the initial measurement of the loan, the finance cost for the year, as well as the closing balance, and we need an exchange gain or loss. Now, my piece of advice would be that when you're doing this kind of a question, which is a blended of Index 109 and 21, forget about the fact initially that there is any element of foreign currency. Tackle the question as if it's a normal question. Forget about the concept of foreign currency. Make the leisure. The conversions can be done at a later stage. So maybe if you want, you can take a snapshot of the question, I guess. I'll just share it for a second. That is the first part. And though this is an RTP question, so this is the second part. It's RTP May 2020. So this was a blended question, 109. So I'm just removing the screen. Now I think let's begin with the inputs. So first we're going to make a ledger account. So let's proceed with the inputs. And let's make a ledger account. And I would advise when you're making a ledger account, make 2 columns in this case. Because one column we'll take it for a foreign currency and the other one we need to convert this into a functional currency. So that is the answer to the question number 6. So this is my financial liability, which is being prepared at amortized cost. So this is the foreign currency and this is the functional currency. Looks like the same. So I think let's put it as FCY, foreign currency. So this is foreign currency, FCY, and this is the functional currency. Okay, so let's, I think, begin with the data. I'm just going to pick up the information. So I am given, it says on 1st April, the company raised a long-term loan from the foreign investors. And the investors, it says, have subscribed for 6 million foreign currency loans at par. But there is also an incremental cost, which is nothing but TC. And I think you know, though I did not make mention, but you know that financial liability, the TC gets reduced. So when you are going to record this on the credit side, that is by bank. So we would consider 6 million would mean 60 lakhs minus the amount of TC. So that works out at 58 lakhs. This is the proceeds at which it is recorded. Then it says further that it is interest is 6 lakh payable annually at, it says, starting on March X2. But we're also given the effective interest rate. So when you consider the finance charge, it is supposed to be on the basis of EIR. So we take the finance charge and the EIR is given at the rate of 12%. So on this, we can take a 12% effective interest rate. That comes to 6,96,000. And I'm also instructed in the question that there is an interest payment which is made at the end of each year, and that is 6 lakh. So this comes on the debit side. The interest is paid in arrears at the end of each year. Pretty simple and straight. I think that's it. So if you technically ask me that if the ledger in terms of foreign currency is done, yes, it is done. Because when you make a ledger on a financial liability at AC, you just consider the interest on the basis of EIR you make a payment, and we get the balance CD as a balancing figure. So I think now it's time to start asking questions. So let me just add and get the balancing figure. So this comes to 58,96,000 is the balancing figure in this ledger. Now I think it's time to put some questions to you based on the concept of Indus 21. So the first question which goes is the conversion, the rates at which the conversions would take place. So let's begin the journey. So I've got a total of 3 transactions. First of all, what is the rate which will be applied to this opening balance, or I would say the proceeds? I'm given 3 rates. One is the rate at the beginning, one is a rate at the end, and one is an average rate. So what rate would apply? Opening, closing, average. So what is the rate of exchange to be applied on this? Opening, closing, or average? This is at the start. And I think I've indirectly answered the question. Okay, I'm here to get a response on that. Yes, that's right. We get an opening. So the opening rate of exchange is supposed to be 2.5. So let's multiply this with 2.5. So into 2.5, this I think comes to 145 lakhs. What about the rate of exchange to be applied on the finance charge? This is a finance charge which is supposed to be entering the profit and loss account, income and expense. And you know the income and expense are considered at what rate? That's right, it would be at the average rate. That is supposed to be 2.42. That makes life simple. 696 into 2.42, that is 16,84,320. And then we have also made a payment at the end of the year. It very clearly says the payment is made at the end of the year. So on this, you would apply undoubtedly a closing rate. So into 2.75, this comes to 16.5 lakhs. And should I consider this to be a balancing figure, or should I apply a rate of exchange? We need to apply a rate of exchange because the balancing figure is going to be the exchange gain or exchange loss. So what exchange rate is to be applied on the balance CD as well? And that's right, it's going to be a closing rate which is at the rate of 2.75. So multiplying 58,96,000 into 2.75, this is 162,14,000. I think now we can comfortably see what is the balancing figure in the ledger. So 145 lakhs, 1684,320, 1650, 162,14. I think we're getting a balancing figure on the credit side. That is 16,79,680. So this is the balancing figure in the ledger. That becomes a foreign exchange loss that will be taken in the profit and loss account. Restatement of the financial liability. Simple and straight indeed. So can you please upload the practice questions on the ICAI board? Yes, I'll definitely do that. There was a little technical issue at my end, so I think I'll definitely do that today. No worries. Right, friends, so the question stands done. It is as easy as that. The idea of doing this question was to tell you that if you see a blend in terms of financial instruments and a foreign currency, don't get scared. Just make the ledger account in terms of foreign currencies and then create a second column on both the sides. Just apply the rate of exchange and it stands done. I guess so far so good. Let's do a similar question on a financial asset with you. So I'm going to share another question to you. So let's have a look at the question number 7. This is RTP November 2020. In the meantime, we can take a snapshot of the screen as well. Now, let's, I think, read the inputs which are given in the question. It says an entity, that is Indian entity, whose functional currency is rupees, purchases. Now, this time we've got a financial asset. Last time the company had issued, it was a financial liability, but this is supposed to be a purchase, a financial asset. Denominated in, it says USD, which is $1,000 fair value. the bond carries a stated interest rate 4.7% on the face value. The said interest is received at the year end. The bond has got a maturity of 5 years and is redeemable at a face value that is $1,250. The fair value of the bond at the end of first year is 1060. The exchange rate on the date of transaction as well as at the year end and the average exchange rates are given. Now it says the entity determined that it is holding the bond as a part of the investment portfolio whose objective is to meet both by holding the asset to collect contractual cash flows and selling the asset. I think the business model stands very clear in the question. There is a dual objective of holding the security till maturity or selling it. So that's a dual objective. So immediately your mind will tell you that when there is a dual objective, it becomes a case of FPT OCI, and if it is a bond, a debt, then it is R. But the good part is the question already tells you that. It says the purchased USD bond is classified under FPT OCI category. Then he also gives you the effective interest rate. Now, this is one thing where people sometimes go wrong, because many people have got a misconception that the concept of EIR is applicable to AC. But if you remember, in the summary chart of financial assets, I very clearly mentioned that EIR is applicable to AC as well as OCI both in terms of debt. And this time we are very clearly given that it is EIR 10%. Calculate the gain or loss to be taken to the P&L and other comprehensive income for year number 1 and also pass journal entry. I think once you make a ledger account, putting the journal entries from that would not be an issue. Now here again we can see a blend of the foreign currency. So what we can do, we will first make a ledger account where we consider everything in foreign currency, that is USD, and then we can keep converting things in Indian rupee. So let me start the inputs on question number 7. So answer to the question number 7, we'll make a ledger account. And this time we're making a financial asset. So again, I'm going to consider 2 columns on the debit as well as on the credit side. One is for the foreign currency, which is USD, and the other one is Indian rupees, that is INR. So this is a financial asset being prepared as per the instructions FPT OCI, and just to make a mention, it is recycling. So first we're going to concentrate completely in terms of the data, that is values in terms of foreign currency. So let's begin the input. It says an Indian entity whose functional currency is rupee purchased a USD bond at a fair value of 1,000, and there's no TC given. So we capture this to bank. We record this at a fair value, that is 1,000. Then it says the bond carries an interest rate of 4.7% on the face value. Now we need to be careful that 1,000 is the fair value. He's yet to instruct what is the face value, though we know it's given later. So we need to be careful that when you calculate the interest collection, it is on a face value. When you consider the interest which is accrued, it is based on EIR. So it says the bond is got a maturity and is redeemable at a face value 1250. So now we know clearly that the coupon rate of interest is going to be received on the face value. So which is supposed to be 4.7% on 1250. So if you take 1250 into 4.7, that's approximately 59. I'm rounding off the answer. And then it says further that the fair value at the end of the year is 1060. Now, since it is supposed to be a case of FPT OCI, the closing balance will consider the fair value. So the opening balance done, the interest rate done, and then it also gives you the effective interest rate, and the effective interest rate is given at the end at 10%. So we take the finance income. We consider a 10% interest, that is 100. That's it. So this stands down. This is like doing a question as if there is no presence of a foreign currency and getting the results. So would you like to help me? Where do I take the balancing figure in this particular case now? So where do you take a balancing figure in this ledger? Let me get the balancing figure. So we're getting a balancing figure on the debit side, which is 19. So what does this 19 represent? That's right, it's go in the OCI because that is supposed to be a fair value gain, and this fair value gain will be taken in the other comprehensive income. Done. So now it's all about conversion in terms of the function currency. So let's start applying the rates. So what is the rate to be applied on the opening balance when you made the investments? Undoubtedly the opening rate, and the opening rate is given 40. So that works out at 40,000. And what about the rate of exchange on the finance income? Can I say this finance income is supposed to be the income to be taken in the profit and loss? So that's going to be the average rate. That is 42. Great. And then if you consider the receipt of the interest is at the end of the year, so that would be at the closing rate. That's 2655. And even the closing balance will be at the closing rate. And that is again at the rate of 45. That works out at 47,700. And then we are also given a foreign exchange gain. Let's put across that question. What is the rate at which the foreign exchange gain is going to be converted? Though it enters, you can say indirectly in your income statement, but it arises at the end of the year. So average or a closing, what do you say? So when you're considering the foreign exchange gain, this arises at the end of the year. So though it's going to go in the income statement, average, or is it going to be closing? Undoubtedly, it's going to be a closing rate. So this is 19 into 45. It comes to 855. Now, we are, of course, going to get a balancing figure in the ledger account. I think before I get the balancing figure, let me ask you, what do you think that balancing figure represents? I've converted all the items in the ledger account at an appropriate exchange rate. Still, we're going to get a difference. And what is that? Is that the foreign exchange gain loss? Is that what is going to be taken in the P&L based as per Ind AS 21? Yes, of course. So let's see what is the balancing figure. It's coming to 5,300, I guess, on the debit side. So this is the balancing figure in the ledger, and this would be taken in the profit and loss that represents a foreign exchange gain as per Ind AS 21, which enters the P&L. Super. I guess so far so good. So this was a warm-up exercise, doing some questions with a blend of 1s and 9 as well as 21. Okay, so far so good. Now we can just go further. Right. Now let me come back to the agenda in terms of financial liability. I think since we have done the concept of making a ledger on a financial liability, I'll just like to make a quick summary of mind map. So the mind map number 1 for the day. So we're going to make our first mind map on the financial liability. So this is the mind map number 1. This is on financial liabilities. So just like we made a chart on financial assets, let's consider a chart on the financial liability. Now, I would just like to remind you, though I'm not putting that in the chart. You know, if you recall, if you've seen those regular sessions, you would recall that financial liabilities are of various kinds. And you can say one financial liability is supposed to be measured at AC, one financial liability is supposed to be measured at FPTPL. There's another one which is called measured at FPTPL, but it is designated to be measured at FPTPL. Apart from that, we've also got contingent consideration, which is payable on a business combination. And there is also the concept of financial guarantee. But in this particular chart, I'm just going to consider three broad categories. Rather, let's put two broad categories. In between, we'll pen down the thoughts in terms of those financial liabilities which are designated to be measured at FVTPL. I'm very keenly interested in asking you, which I'll ask you very shortly, but just think. What is the distinction between a financial liability which is measured at FVTPL and which is designated to be measured at FVTPL? In the meantime, as we make the chart, give your thoughts. That what is the difference in the accounting treatment of financial liabilities which are measured at FVTPL and those which are designated? Because when you say they are designated to be measured, it is on account of eliminating or reducing the accounting mismatch. Financial liabilities which will per se fulfill the criteria of amortized cost will be measured at FVTPL because the company wants to reduce or eliminate the accounting mismatch. So where do we take the fair value changes for those liability? Give me your thoughts in the meantime. So let's make a summary chart on the financial liabilities. I'll take three columns. A column for a particulars, then amortized cost, and then it is FVTPL. And let me make it very clear that there is no concept of FPT OCI as far as financial liabilities are concerned. Okay, I get the inputs, it is taken in the P&L. So fair value changes in FPTPL, of course, goes in P&L. But what about the fair value changes for a liability designated at FPTPL? So let's make the inputs. First, we've got initial measurement. What is the value at which the financial liabilities are initially measured? And I think at this stage, I'd also like to make a quick mention on this chart itself, that as far as financial liabilities are concerned, they are always at fair value. They're always at a fair value, but then there are two exceptions, just like the case of financial assets. The first exception is a case of trade payable, and the second exception is the loan which is payable on demand. The loan which is payable on demand. These are taken at a transaction price. If you remember, even in terms of financial assets, there were two exceptions, trade receivable as well as loan recoverable on demand. Same goes for financial liabilities. If there is a trades payable, loans payable on demand, they are taken at a transaction price. Other than that, all financial liabilities are taken at a fair value. So if you come back to the chart, on the initial measurement, it will be a fair value minus the TC. You've already seen that. In the question number 5 today, we already saw that it is supposed to be the minus TC. I think I got the right answer now. And in terms of FPTPL, it is fair value. Just to put it in the brackets, the transaction cost is charged to profit and loss account. It is taken to the P&L. The second is whether the concept of EIR is applicable in terms of EC. Yes. In terms of FPTPL, of course, no. The third aspect is the subsequent measurement. The third aspect is the subsequent measurement. So when I say the subsequent measurement, the focus is in terms of identifying the fair value changes. Are they to be captured or not? In terms of EC, no. In terms of P&L, yes. And I think now it makes sense to segregate that. So I am now segregating those financial liabilities measured at FVTPL and those designated. So let's, I think, make the inputs at the stage. If they are measured at FVTPL or they are designated, to be measured at FVTPL. So the fair value change is, of course, measured. I get the answer in a designated FVTPL. We recognize own credit risk in OCI and the balance is taken in P&L. That's absolutely correct. So in terms of FVTPL, the changes are taken in the P&L. But if it is designated, then whatever is the change due to own credit risk, whatever is the change due to own credit risk is taken in the other comprehensive income, and you can say the rest of the fair value changes is taken in the profit and loss. And when you say that it is a case of designated, I guess worth making a mention that this is a case when concept of the concept of reducing or eliminating, when the concept of reducing or eliminating, the concept of reducing or eliminating accounting mismatch is applied. When the concept of reducing or eliminating the accounting mismatch is applied. Wow. I think that takes care of the input in terms of the financial liabilities, my man. I think typically the issues are initial, subsequent year, the concept of impairment does not apply, and the concept of realized gain or loss does not apply because financial liabilities will of course be settled and they are not going to be sold like financial assets. Great. So I think I don't see that there's a need in terms of doing a question on the financial liability ledger. So what do you say? If that's manageable, I'll skip that question. So do you want me to do a question on the financial liabilities amortized cost, or if that's manageable, I'll skip that part. Maybe we can go on to the financial liabilities in terms of financial guarantees. So what do you say? Manageable? Okay, wonderful indeed. So we'll come to the financial guarantees question, I guess. So let me do one thing. I'll take a little jump and go to a little special accounting in terms of financial guarantee. So here goes the question. So look at the question number 14. In between, we put some more questions on financial assets, which we were talking in terms of differences between a transaction price and the fair value, which I'll come to later. But first, I guess let's have a look at the financial guarantee question, a special issue, I would say, on financial liability. So this question came in RTPs in May 21, as also seen in MTP as well, mock test papers. Now it says on 1st April X1, Sun Limited guarantees a 10 lakh loan of the subsidiary, that is Moon Limited, which the bank provided to Moon for a period of 3 years at 8%. So the parent gives a financial guarantee to the bankers for the loan given to the subsidiary. The interest payments are made at the end of each year and the principal is repaid at the end of the term loan. If Sun had not issued a guarantee, the bank would have charged Moon an interest rate of 11%. So we can definitely identify at this stage the interest rate without the guarantee 11%. The interest rate with the guarantee is 8%. So we know the value of the guarantee is the difference between the interest rate, that is 3%. It says Sun does not charge Moon for providing the guarantee. On March X2, there is a 1% probability that Moon may default on the loan in the next 12 months. If Moon defaults on the loan, Sun does not expect to recover any amount from Moon. Then he says on March X3, this probability is now 3% that Moon may default on the loan in the next 12 months. If Moon defaults on the loan, Sun does not expect to recover any amount. And then it says provide the accounting treatment of financial guarantee as per Index 109 in the books of Sun Limited in the initial recognition and in the subsequent period. So now what we need to do, first of all, we need to identify the value of the financial guarantee. So you can maybe take a snapshot of the screen and then we can start. So that becomes a little special case in terms of financial liabilities accounting. So let's go to the question number 14. So the first thing what we need to do is we need to get what is the financial guarantee fair value. So we're looking at financial guarantee. So we're looking at the fair value of the financial guarantee. So whenever you're considering the fair value of the financial guarantee, you need to compare the interest rate with without guarantee. So in this particular case, to calculate a fair value, we need to consider the financial guarantee, the interest rate without financial guarantee. So we take care of the interest rate without the financial guarantee, and we take care of the interest rate with financial guarantee. So very clearly the instructions are given in the question that the financial guarantee, which is the interest rate without the financial guarantee, is supposed to be 11%, and this is supposed to be 8%. So the difference in this case works out at 3%. So let me say a sentence, maybe you can vouch me for that. So can I say, when you're going to consider the fair value of the financial guarantee, is it the present value of the 3% interest for a period of 3 years, the loan tenure? So can I say that in this particular case, the fair value is the present value of the 3% interest for the next 3 years? Correct. So we know in this particular case, the loan is for 10 lakh rupees. We take a 3% interest and we need a 3 years factor. That's right. So let's take a 3 years factors at the rate of 11%. So at 11%, 1, 2, 3, this is coming to 2.444. That comes to 2.444. So on 10 lakh rupees, we take a 3% interest that works out at 73,200 is the fair value of the financial guarantee. Right. So I think once this is done, now we are ready in terms of doing the accounting of this financial guarantee for the next 3 years to come. So let me now ask you, what is the value at which the financial guarantee is taken in the books of accounts at each year end? Can I say get the amortized value of this financial liability and also get the amount of provision which is required for the ECL? So are you going to consider the lower of the two or greater of the two? You need to consider the amortized value of this liability. One, you will get the provision for ECL, that if there is a default, what is the provision for an expected credit loss which would occur, whichever is lower or whichever is higher. And that's right, higher of the two. So let's make a mention at this stage that the financial guarantee measurement, is going to be equal to higher of the two. It's going to be the higher of the two. So we need the amortized value. We need the amortized value of this guarantee. And we need the provision for ECL, expected credit loss in case of a default, whichever turns out to be great. So we need to do this exercise for 2 consecutive years, that is March X2 as well as March X3. So let's go to the 2 consecutive years. One is March X2. So let's first make a small little leisure to calculate the amortized cost of the financial liability. So we want to calculate the amortized cost of the financial liability. So in this particular case, we first consider the value. So this is supposed to be, I guess, 73,320. That's the fair value, 73,200, sorry. So this comes to a total of 73,200. So I think I've taken this correct, 73,200. It's 3,000 into, this is 73,220 only. I think I need to rectify this. On 10 lakh rupees, 3%, 2.444. This is 73,320 only. So this is 73,320. And we just prepare this exactly what you do in amortized cost accounting, unwind the interest, and then the benefits transferred. The benefits being transferred to the subsidiary company is the 3% on 10 lakhs each year. So we first take interest on this at the rate of 11%. So this comes to 8065 approximately. And the benefits which is paid is the 3% on 10 lakh. This is the benefits paid. So this becomes, in a way, the balancing figure, just like a amortized cost ledger is prepared. 73,320, 8065 minus 30, that comes to 51385. So this is the amortized value of the financial liability at the end of March X2. Now we need to consider, if a default occurs, then what is the provisioning for ECL? So let's consider what is the provision for expected credit loss. And I think for this, I'd like to go back to the question, share the data to you. So it says out here for March X2, it says on March X2, there is a 1% probability that Moon may default on the loan in the next 12 months. So you are given the POD, the probability of default is 1%, which is next 12 months. That means it is a 12 months ECL. The calculations on a 12 months ECL, the POD is at the rate of 1%. And you are not expected to recover any amount. Now, technically speaking, when you're making a provision for the expected loss, you know it is a sum total, it's rather a product based on three factors. One is you consider EAD, and that is nothing but the amount of the loan into the LGD. In this case, I am not given any security value. I'm not given that there is any recoverability which is happening. So indirectly, the loss given default is 100%, because I'm not expected to recover anything. So the LGD becomes basically 100%, and then multiply this with the POD. So let's show the calculations. It is going to be EAD, exposure at default, into LGD, that is loss given default, into the POD. And if it is required, we need to consider the concept of time value of money as well. But in this case, we are not considering that part. So we are given the EAD is 10 lakh. Loss given default is 100% because no recovery. And the probability of default is 1%. So we can say on 10 lakh rupees, 1% that comes to 10,000. So we need to consider whichever is higher. We need to consider whichever is higher. So we consider 51,385. So now the question what comes to the mind is, in this particular case, once you measure the financial liability at 51,385, where do you take the difference in the financial guarantee value? Since it is a financial guarantee, it is measured at FPTPL. So am I supposed to take the difference between the fair value at the beginning and at the end in the profit and loss account? Yes, it is measured at FPTPL. So the entry becomes financial liability gets a debit, profit and loss gets a credit, and we take the difference between 73,320, 51,385. So the difference works out at 21,935. The difference is 21,935. So reduction in the value of the financial liability is taken in the profit and loss. Great. Now on the similar lines, let's do the calculation for March X3 as well, though it is exactly on the same lines. So let's make the amortized value of this liability. So this comes to 51,385. We take 11% unwinding on this. 51,385, 11% would mean 5652 approximately. and then the benefits paid is 30. So we get the balancing figure 51385. That comes to 27037. So this is the amortized value. And then we can go further and make the same calculations, provision for ECL. So we apply the same concept, exposure at default, loss given default, and the probability of default. Even at the end of March X3, we are very clearly given that there is going to be no recovery if there is a default. If there is going to be no recovery, which means the loss given default is 100%. So this is 10 lakhs. Loss given default is 100%. And I think this time the probability of default is undergone a change. I guess it is coming to 3% is the probability of default. So that comes to a total of 30,000. So this time again, we're going to consider the higher of the two. So we need to bring the financial guarantee to the extent of 30,000. So we can put the entry, financial liability gets a debit, profit and loss gets a credit. The difference between 51,385 and 30, that's 21,385. This is the amount with which the entry is done. Right, I guess that's pretty simple and straight, nothing too technical. I think once you get the feel of how do you proceed with the questions, it's an easy exercise. Financial assets done, financial liabilities with a little special issue in terms of financial guarantees also done. Any questions, friends, at this stage coming to your mind? I think we're going all good. It's all simple. Now we need to get a little more technical. So let's come to some special agenda mind map number 2. I'd now like to, first take a little quick look at the chain of thought with which you need to revise in this 109. If you remember, last time I gave you a chart in terms of flow chart, how your mind has to be tuned in terms of revising Index 32. So this time I'm going to do that exercise in between. So I'm just coming to the chain of thought. In terms of Index 109, what is going to be the flow chart at the back of your mind when you're revising this particular standard? I think let's give you the inputs and then we'll proceed accordingly. When it comes to the inputs in terms of 109, your focus turns in terms of 2 point of view. One is the holder's point of view, and the focus is the issuer point of view. That means the focus is on the financial asset and the focus is on a financial liability. Now we've discussed certain issues and I'm just going to add the chain of thought that you're clear in terms of how you're going to revise. In terms of financial assets, we've already seen that you categorize them as debt investments or you categorize them as equity investments. And when it comes to the case of a debt investments, they are further segregated in 3 categories and equity in 2 categories. This is amortized cost, fair value through OCI, which is R, and a fair value through P&L. This is fair value through OCI, there is NR, and this is fair value through P&L. This we've already seen in the last class where we saw all the 5 cases and I gave you a summary chart in terms of all the accounting treatments. Now, what is to be taken care out here is a special issue. Your mind should turn to a little special issue in terms of financial assets, which I am now going to deal with. I'm going to revise that with you. So if you remember that financial assets are initially measured at a fair value, but then there could be a difference between a transaction price and a fair value. So the special issue is when there is a difference between the fair value and the transaction price. I'm talking in terms of those concession loans given to the staff. I'm talking in terms of the loans which a parent gives to the subsidiary. I'm talking in terms of interest-free security deposits made to the lessor. So all that will become a part of the special issue discussions which I'm going to discuss now. Next, when it comes to the financial liabilities, in this particular case, we've seen that typically the liabilities would be either AC or it is FPTPL. And we've already seen a special issue here as well. I would say the special issue in this particular case is in terms of accounting for financial guarantee. So we've already seen the accounting of financial guarantee has got a little different measurement base. This is what we've done so far. So this is one area which we're touching upon. Then once this is done, your mind should flow into another direction. And that is, you need to consider in terms of financial assets, the concept of derecognition. You need to consider the concept of impairment. So you need to consider what are the principles in terms of derecognition of financial assets, impairment of financial assets. In terms of financial liability, you need to cover the concept of derecognition. Impairment, of course, is not applicable in terms of liability. So two issues on the financial assets and one issue on the financial liabilities on a derecognition. And then comes the picture in terms of taking certain special issues in financial instruments and the special issues in terms of hedging, the special issue in terms of derivative as well as embedded derivative accounting. That's how the entire input gets built in. So you will be able to get a complete flow chart in terms of things. So what we need to discuss now is this special issue, then considering derecognitions, then impairment, then hedging and derivative. So I know the time is less, we've got a lot of things to do. So I'm going to make some quick mind maps and keep proceeding with some questions along. So let's, I think, make a second mind map on this special issue. So this chart will help you when you are going to sit down and revise. It's very important that the flow of the standard is there at the back of the mind. You know how the flow of revision should go. So let's come to the mind map number 2. Let's come to the mind map number 2 for the day. And this is with reference to the comparison between fair value versus the transaction price. That when there is a difference in terms of fair value as well as in terms of transaction price, how do you tackle that particular difference? So I think in this particular case, let's first make a little chart on this clarity. So in this case, let's remind ourselves the concept. I would say it all depends upon the source of the fair value. Let me first remind you, the first thing what you need to do is that see that is the transaction at market terms or off market terms. So I think let's convert this into a 3-step model, of course. So let's convert this again into a 3-step model to keep in mind the nitty-gritties in terms of fair value versus TP. So the first thing which you need to watch out in the question is, look at, is it at market terms or off market terms? How do you do that? You compare the contracted rate versus the market rate. If the market rate and the contracted rate is same, it is at market terms. In those cases, there is no difference between a fair value and a transaction price. But if your contracted rate is lesser as compared to the market rate, it is an off-market transaction, then you go to the step number 2. So in terms of the step number 1, you need to identify is the transaction at market terms or off market terms? Is it at market terms or is it off market terms? So the first thing to see in the question is to see whether it is at market terms or is it off market terms. If it is at market terms, you will clearly see the input that the contracted rate, and putting the CR is equal to the market rate, that is MR. And in this particular case, the transaction value is always equal to the fair value. Call it as a transaction price or a transaction value, one and the same thing. So the contracted and the market rate is same, and the transaction value and the fair value is the same. But if it is supposed to be off market terms, we'll certainly see that the contracted rate is less than the market rate. And in this particular case, we need to go to the step number 2. So this is one observation which you need to make in the question, that first you compare the CR and the MR. Next. The second is the step number 2. And the step number 2 is to see the source of fair value. The second is to see the source of the fair value. Now you would recall that when you look at the source of the fair value, it is either supposed to be observable data or it is unobservable data. If it is supposed to be observable data, in that particular case, the difference between the transaction price and the fair value is called a day one gain or loss as per Index 113. And the difference is adjusted in the profit and loss immediately. But if it is supposed to be based on unobservable data, then you go to the step number 3 to look into the kind of relationships. So in this case, when you say the source of the fair value, so we can say the source of the fair value could be an observable data. It could be observable data, or it is supposed to be unobservable data. So when you say that it is supposed to be observable data, then the difference is simply day one gain or loss. In this particular case, the difference is equal to what is called a day one gain or loss. And that day one gain or loss is simply taken to the profit and loss on the first day itself. The second is, if it is unobservable data, then it's time to go to the step number 3. Then it's time to go to the step number 3 in this case. And the step 3 is the crucial step where you start looking into the types of relationship, which I'll just give you. So in this particular case, when we go to the step number 3, now it's time to look into the type of relationship. Though if you remember, even in the regular sessions, I made a clear-cut mention that this is not a comprehensive list of the relationship, but generally based on the questions which are there, you can see that broadly you're going to see 3 kinds of relationship in terms of deciding the difference to be treated. So we can divide this in 3 parts. So we can say in the first one, there could be an employer-employee relationship. There could be an employer-employee relationship. So if there is an employer-employee relationship, it becomes a case of, for example, a concession loan. I know I've not been asking too many questions as I make mind maps, trying to save a little time. But in between, if you feel, you can give your answers as well. So if there is going to be a concession loan, in this particular case, employer-employee relationship, this is going to be called as a prepaid staff expense, which is going to be amortized over the period of the loan on a straight line. So in this particular case, we can say the difference is going to be treated as a prepaid staff cost. The difference is going to be called as a prepaid staff cost in this case. And when you say that this difference is a prepaid staff cost, it is amortized. It is amortized on straight line method over the period of loan. So whatever is the period of the loan, this is going to be spread over the period of the loan on a straight line. So this will be annually amortized over the period of the loan. The second input, that is relationship, is, you can say, the parent subsidiary. It is supposed to be a parent subsidiary relationship. So when you say it is a parent subsidiary relationship, then the difference which arises between these two is what? I guess if I consider that it is a loan which is given by the parent to the subsidiary, then this is going to be treated as a deemed equity investment. Because when the parent made investment in the subsidiary, and in this particular case, we know the CR is less than MR, this is going to become a deemed equity investment. This is a deemed equity investment, and no amortization of this particular amount is going to occur. So this amount would remain as it is in the financials. Then the third category of relationship is, you can say, the lesser lessee. That is supposed to be a lesser lessee, where there is supposed to be a security deposit. So in terms of employer-employee, it's a concession loan. This is again a loan, and this is a security deposit between the lesser lessee, the customer-supplier relationship. And in this particular case, the difference will be treated in terms of ROU asset. The difference is taken in terms of ROU asset. So in case of security deposit, ROU asset, and amortized over the useful life of ROU asset. Great, I like that. So this difference, that is ROU asset, is going to be depreciated. It is going to be depreciated as per the lease standard, that is Ind AS 116, based on the lease term. Depends upon the fact, it could be sometimes a useful life, it could be a lease term, that depends upon Ind AS 116, I would say. Right, so this, I think, creates my second mind map, which is a very crucial area, because this is, I think, very well tested in the exams. Highly tested in the exams, in terms of the fact that the examiner is interested in knowing that in terms of various kind of relationship, how do you tackle the difference between the transaction value and the fair value? So I think you wanted to do questions on this area, of course, since it is one of the most crucial areas. I think we're definitely interested in terms of doing questions on these area. Maybe we can do the initial entry, leave the subsidy accounting in these cases, but I think we should definitely do that. What do you say? Yes, I think. So let me share the questions on the screen back to you. I'm now going back. So let's have a look now at the question number 8, which is on a concessional loan. So let me read the facts of the case. This is a November 2020 examination question, which came for 12 marks in the exam. Now it says on 1st April 2020, it says S advanced a housing loan of 15 lakhs to one of its employee at an interest rate of 6%, which is repayable in 5 equal annual installments along with the interest at each year end. Now, I think this is one point of confusion. Many people tend to get confused after reading this input. So I think it's time to put a question to you. Are we making a repayment in terms of 5 equal principal installments? Or are we making a payment which is 5 equated installments? It says that we are going to make a payment 5 equal installments with interest at the end of the year. So is he talking of 5 equal principal repayments, or is he talking of 5 equated installments? Because the word is very clear, along with. Along with means like a together, that means something which is plus. And that's right, it is supposed to be 5 equal principal repayments, and then we'll add the interest on a separate basis. Correct. And then it says that employee is not required to give any specific performance against the benefit. Well, that doesn't make a difference to the accounting. Even if the employee is required to give some kind of benefit performance, that doesn't make a difference to the accounting. The market rate of interest for housing loans is 10% per annum. Now, the contracted rate is 6% and the market rate is 10%, which is undoubtedly indicative that this is a concession loan and the relationship of employee is quite visible indeed. The accountant of the company recognized the staff loan in the balance sheet equal to the loan, which is 15 lakh. The interest income which he took in the P&L is at the rate of 6%. So the accountant did everything incorrect. He recorded the loan at a transaction value, 1, and he captured the interest at the contracted rate itself. That's all incorrect accounting. It says analyze the above accounting treatment made by the accountant. Is it in compliance with the relevant Ind AS? If not, advise the correct treatment of the housing loan, the interest and the other expense. Other expense means the prepaid staff cost, which you will get. In the financial statements for the year 2021, along with workings and applicable Ind AS. You're required to explain how the housing loan should be reflected in the Ind AS compliant balance sheet on March 21. I think once you read the facts of the case, you will immediately get the feel that yes, we are looking in terms of a prepaid staff cost. I think let's begin the journey. So question number 8. So I think there are a few workings which we need to do at the inception. Number 1, you need to get the fair value of the loan. And what is the fair value of the loan? It is the present value of all the interest and principal repayments which the employer will get. So the first thing is to compute the fair value. So we need the computation of the fair value. So for this purpose, we need to consider the present value of all the receipts in this case. So let's begin the journey. So I am very clearly given that the principal repayment is made in 3 5 equal installments. So let's make a small little chart. Here, there will be a principal collection. There will be an interest collection. So we can get the total collections, take the discounting factor, get the present value. So we just need to organize the data, the principal, the interest, the total, and take a discounted value. And this is going to give us the fair value. So we just now organize the inputs in this case. So we've got here 1, 2, 3, 4, 5. Now the principal repayment is very clear. So the loan is for 15 lakhs. It is payable in 5 equal installments every year. 3 lakhs is collected by the employer. Every year, we can say 3 lakhs is collected by the employer. And I guess let's now calculate the interest as well. So if you consider the interest, so we know the interest is at the rate of 6%. So this is going to be 90,000. And I think now comfortably you will agree that you can keep reducing the interest by 1/5 every year. Since you are making a principal collection of 1/5 every year, the interest is on the outstanding balance. So comfortably reduce it by 1/5 every year. So reducing it by 18,000. Reducing it by 18,000. So that's how we get the interest on the outstanding balances. And let's take the sum total. That's 3,90,000. That's 372. That's 354. That's 336. And that's 3,18,000. And I think let's at least ask you, what is the rate at which a discounting would occur? Are you going to consider the interest which is 6% or the rate which is without the concession 10%? It says market rate on the similar loans is at the rate of 10%. So what is the rate at which a discounting will be done? Of course, at the rate of 10%. That's right. So let's take the factors at 10%, 909, 826, 751, 683, and 621. So I think I'm going to apply a little shortcut and give you the answer of the fair value directly instead of computing. So I think if you do this, 1354, 602, that is the value. So I think this is the first element which you need to do in the question. Organize the fair value at the inception. Okay, now with this, let's come further. So we'll do the entry at the inception. At least have a little basic look at how the initial accounting will look like. So let's now look at the initial recognition. Let's look at the input in terms of initial recognition in this case. Now, if you look at the initial recognition, so we would first of all record a financial asset in the books as an employer. So as an employer, you are going to record, first of all, in this particular case, an amount that is the financial asset at a fair value. This is 1354. This is 1354,602. And we record the figure that is bank. The amount of loan is 15 lakhs. So this is the fair value. This is the transaction value. And this is supposed to be the balancing figure. And I think you already know this well, that this difference is going to be called as a prepaid staff cost. So this is going to be called as a prepaid staff cost. So we get the balancing figure, that is the prepaid staff cost. So this is 15 lakhs minus 1354,602. This is 145,398. Okay, now quick questions. So once we've got the figures, I think now some quick questions to you. Is this financial asset going to be prepared like a debt investments at AC? Yes or no? Are we going to prepare this at just like a debt investments at amortized cost accounting financial asset? Yes or no? And that's right. So I'll just make a quick mention on this, that this is like a debt investment at amortized cost accounting. And can I say the prepaid staff cost, as we made a mention, amortized on a straight line basis for a period of 5 years in the P&L. So this is going to be amortized. This is going to be amortized over 5 years. That's the life of the loan on straight line method. So you want me to make the ledger accounts for the financial asset, or I think that seems to be good enough. I think you can take the journey forward from here. I think so, but let's still take your call. Is that manageable? You will be able to make the ledger account for the financial asset at AC going forward with the next 5 years, I guess. Yes, I think that's manageable. I think, yes, you're absolutely correct. Because once you get the initial recognition, then I think it's not a very difficult deal at all in this case. Okay. Now, so one special issue in terms of difference in transaction value and fair value done. Let's go to the next one. I'll share another question out here. Let's have a look now at question number 9. That is again an examination question that came in December 2021 for 5 marks in the exam. So that's again pretty simple and straight indeed. Let's have a look. It says M made a security deposit whose details are given. The date of the security deposit, start and end is given. So it's a period of 5 years. And we are given it's a lease, and the deposit and the discounting factor is given. Then it says determine how the financial asset is measured and briefly explain the measurement determined as such. Make necessary entries for the amount of deposit in the first year and last year. Assume a market rate of deposit for a similar period is at the rate of 9%. Now we can very clearly see that in this particular case, the contracted rate is supposed to be zero. I'm not given that there is any interest rate which is being paid on the deposit, but the market rate on a similar deposit is at the rate of 9%, undoubtedly an off market transaction. And therefore, we can see the relationship is the lesser lessee. So we know the difference is going to be taken in the right of use asset. So let's organize the initial entries to you. So question number 9. So we'll just look at the initial entry. And I think in all these questions, you will agree, the very first thing you are required to do is to consider, always in these kind of questions, you need to consider the computation of the fair value. That's the first key issue to be done. So let's go for the computation of fair value. So computation of fair value. Then I think we'll just look at the initial entry. So in terms of the computation of the fair value, I think in this case as a lessor, I am not getting any interest on the deposit. Sorry, as a lessee, I'm not getting any interest on the deposit. So the only inflow is the refund of the principal at the end of fifth year. So in terms of fair value, we can take year, we can take the amount, we can discount it, and we can get the present value. So unlike the previous questions, the collections of interest and the principal was happening. But in this particular case, there is only a refund of the initial deposit in this particular case. So let's proceed further. So we are going to get the refund at the end of fifth year. So what is the deposit amount? I'll just come back to it. So my deposit is to the extent of 20 lakhs. And I think the factor is slightly misprint if I remember. Let me just calculate at the rate of 9%. It's no correct. It is 0.649. I think in the question it was slightly mentioned incorrect as 6499. So maybe you can rectify that in the screenshot out here. So I think it's mentioned as 6499. So it's right. 6499 is correct. That's right. Okay, so far so good on this. So 20 lakhs into 6499, that's 12,99,800. 12,99,800. So that becomes the fair value. I think we can now simply look at the entry in the books of accounts. So we're looking at the entry in the books of accounts of the lessee. So he is going to first put the entry security deposit gets a debit. The security deposit gets a debit. The bank gets a credit. The deposit will be captured at 12,99,800 and the deposit made is 20 lakhs. This is the fair value. This is the transaction value. And we take a balancing figure, and you know this well in advance. The balancing figure is supposed to be the right of use asset in this case. So the balancing figure is the right of use asset, that's rightly said. So 20 lakhs minus 12,99,800, that's 7,200,000. And I guess let's put that question back to you once again. Is this security deposit to be accounted like the debt investments at AC? Is the same accounting going to be applicable, making the debt investments at amortized cost approach? And that's right. So I think I'll just make a quick mention on that. So the security deposit will be accounted like a debt investments at amortized cost. And can I say the ROU asset is going to be depreciated? This is going to be depreciated over the life that is based on Ind AS 116. So this is going to be depreciated over a period of time. So I think you will be able to manage the accounting of the deposit account as well. I think, we're just trying to save a little time so we can cover things extra. So wherever I think this is comfortable, we can keep skipping that. So I think you'll manage the security deposit account, right? Okay, so I think, yes, that should be manageable indeed. Yes, manageable. Great, wonderful. Okay, then let's go further. So I'm now going to the third situation. Let's have a look at the question number 10. That is again an examination question. It came in May 2018 in the exams for 8 marks. This is on the loan which a parent gave to the subsidiary, or you can say the investment made by the parent in the preference shares, and the difference in transaction and the fair value is going to become a case of deemed equity investments. Let's read. It says S issued redeemable preference shares to the holding company, and the terms of the instruments are defined. So we're given the repayment is after 3 years. The date of allotment is April 15, and the date of repayment is March 18. The value of the preference share is given. The dividend rate is given 0.0001. It's as good as zero. It's negligible in nature. And the market rate is 12%. So very clearly the deal can be seen. The contracted rate is zero and the market rate is 12%. And I think there's a slight little misprint. I think the factor is not 1118. I think it is 7118. So I think it's coming to 0.7118. So we'll take that rectified figure. Analyze the given situations, applying the guidance in 109, and account for this in the books of H Limited. So I think let's proceed if you've taken a snapshot of the screen as well. So let's come to the question number 10. So this is our third situation in terms of transaction value and fair value. Invariably, you see most of the questions which are there are pertaining to this part. That also reminds me that there is another special issue in terms of financial assets, which is like, repayment. You receive certain lump sum in between. It's like, a case where the employee makes a prepayment. So that's another special issue. I've taken that question as well, where the employee makes a prepayment, then it becomes a very good blend. I think I'm definitely doing that question because I think that is again a question which has come, I think, around 2 or 3 times in the exam, where it's a blend of a difference between a transaction value and a fair value, coupled with the fact that there is a prepayment of the staff loan. I think we should definitely do that. So let's again come back on the agenda and let's look at the computation of fair value. And in this kind of questions, when there is a difference in the transaction value and the fair value, I think it is also important that, in the exams, you should give a little elaborative note explaining that, this difference is attributed to what. So though you're computing things, but I think you can just make a little note and explain to the examiner, because many places, you can see, like, for example, in this case, it says, analyze the given situation. And applying the guidance, it says, applying the guidance and then account. So when it says analyze, your analysis should also be given to the examiner, that what kind of analysis you've made. Accounting entries is one thing, but documenting the analysis is also important. So for the computation of fair value, same kind of data. We've got year, we've got amount, the present value factor, and the present value. So as a parent, he's getting no dividends. just a repayment of the principal. Just the repayment of the principal will occur at the end. So we're just going to organize the collection of the principal money. So the preference shares are issued, I guess, at 500 lakhs. So this is at the end of, I guess, third year. This is 500 lakhs. And we need a PVIF at 12%. That's 0.7118. So we get the present value 500. This is 355.9 lakhs. 355.9 lakhs. That is the computation of the fair value. So let's now begin with the entries initially. So there is going to be investment. There is going to be investment in the preference shares by the parent. So he's made an investment in redeemable preference shares. That gets a debit. And the bank gets a credit. This is with a fair value 355.9 lakhs. And this is with the transaction value, that is 500 lakhs. And just to ask you again, where are you going to take the difference in this particular case? Where are you going to take the balancing figure in the books of parent? 144.1 lakhs is the balancing figure. And where are you going to take this difference as? Is this going to become a deemed equity investments in the books of the parent? Yes. So this is going to be a deemed equity investments. So the deemed equity investment gets a debit in this particular case. Now, let me again put the same question back to you. Is this investment in preference shares going to be accounted as a debt investments at AC again? Is this financial asset, is this investment in preference shares accounted as a debt investments at AC? Yes, of course. This is going to be again accounted at AC. So this is going to be accounted like a debt investments at amortized cost. And what about this deemed equity investments? Is it going to remain the same or is it going to change? What do you say? What about this deemed equity investments? Unlike an RU asset which was amortized, a prepaid staff cost which was also amortized, any treatment for this deemed equity investments or remains intact? Yes, it remains intact, so this remains the same. Right, so I think all the permutations and combinations in this case done. We are done with the inputs in terms of the special issues on the financial assets with you. Now, if you look at the major core area in terms of financial assets, everything is done. The 5 categories of debt and equity investments, the special issue pertaining to this. But I'll just like you to go back on the chain. I just like to go back on the chain and show you the inputs which I made. And let me just add another special issue. Generally, the facts. So I am given, first of all, the inputs. Lovely has a policy of providing subsidy on the agenda. Then I'm given the following terms are given for the loan is 3 years. Now it says there is a prepayment, full or partial, at the option of the employee. Now the problem is that once the employee makes a prepayment, the entire schedule will get disturbed. But most importantly, the prepayment has to be split in terms of 2 components of cost. The accrued interest shall be paid on an annual basis. The market rate of interest on a similar loan is at the rate of 12%. So very clear, the contracted rate is below the 12% mark, and therefore it's an off-market transactions, employee relationship, and therefore it's a concession loan. Then I am given further the following table shows the expected contractual cash flows from the loan which is given to Civil. So we're given a complete chart regarding the principal collections by the company, the interest collections at the rate of 8% and 5%. And then it says Simran prepays on March 2019, 1 lakh rupee. And then it says following this, the actual cash flows after the prepayment have undergone a change. So we can see that instead of the 3 lakhs each year, it becomes 3, 4, and 2 because 1 lakh extra payment is made at the end of the second year. And accordingly, the interest calculations are undergone a change. You are required to put entries in the books of Lovely considering the requirements of Ind AS 109. So if you technically look at this, you can say it's a case of a special issue, a concession staff loan with a blend of prepayment attached. So I guess let's begin the journey. Now, the only crucial point which we need to take care in this case is, first I need to do the calculation of the fair value, prepare my loan account up to the date of repayment, and then consider the accounting treatment for the prepayment. So let's begin. So this is the question number I gave you is 12. So this is question number 12. So at the first instance, we need to consider the computation of fair value. So we need to consider the computation of the fair value. So in this particular case, I think I'll just take some quick inputs in terms of making the charts. So let's consider year. Then there is going to be a principal and there is going to be interest. Then there is a total amount. You do the discounting and you get the present value. So the data for the principal and interest collections is already defined in the question. We just go to pick up the information and just fill in the data. So we've got a loan which is spanning for a period of, I guess, 3 years. So year 1, year 2, year 3. Now this loan, which is to the extent of 9 lakhs, we're already given a chart in the question. So I'm just copying the data as it is. So 3 lakhs, 3 lakhs, and 3 lakhs. This is the repayment schedule already defined. And the interest is, I guess, 63. And I think this was 39. I'm just copying the information from the question. This is 15. So this is all what is given in the question. The very first chart in the question is giving you a clear-cut idea in terms of the principal and the interest. So this works out at 363. This is 339. And this is 3,15,000. And you need to discount this at a comparable interest rate in the market, which is, I guess, at the rate of 5%. Oh, sorry. It's, I guess, at what rate? I think it's 12%. The market rate which is comparable is 12%. So if I take the factors at 12%, it's 893, 797, and I think it's 712. So I'll give you the multiplied product already. So let's take the sum total. This is 818. This is 818,622. So you will notice a complete flow in terms of, calculating and presenting the answers in all these last 3 in the 4th question. Every time there is a concept of a transaction value, fair value difference, we're doing the calculation of the fair value based on the present value of all the future contractual cash inflow at a market rate which is comparable. And then you get the difference between the fair value and the transaction price. Okay, so let's now look at the entry. So this is going to be loan, that is financial asset in the books, and the bank gets a credit. So the fair value of the loan is 818,622. This is 818,622. That is the fair value. And this is the transaction value, which is 9 lakhs. And we get the balancing figure. This is going to be the prepaid staff cost. This is the prepaid staff cost. So this becomes a balancing figure with us. So 9 lakhs minus 818,622, that's 81,378. Okay, I think same questions back to you once again. So are you going to make this loan account at a debt investment AC? Are you going to amortize the prepaid staff cost on a straight line 3 years? Same question back again. So in this particular case, is this going to be prepared like a debt investments at AC? Yes, of course. And is this going to be amortized over 3 years? Yes, of course. It is going to be amortized straight line method over a period of 3 years in this case. Now, this is the initial accounting done. Now, what am I supposed to do? At the end of the second year, the employee makes a prepayment of another 1 lakh rupee. So I think the first instance, what we need to do, we should make the ledger account for the loan and see what is the position after the first year gets over, and then we will see the treatment of the prepayment. So let's do one thing. Let's make a ledger account, and let's make a ledger account for two. So one is we're making the financial asset, that is the loan account. So I'm making one loan account FA, and I'm also making the prepaid staff cost account. At least let's see the position at the end of the first year before we proceed. So the financial asset is recorded. This is bank. This is 818,622. We take the finance income. Tell me at what rate. We take the finance income on this. Tell me at what rate. So it is a loan where the market rate is 12%. That's right. So we'll take a finance income at the rate of 12% on this. So 818,622. That's 98,235. So 98,235 is the finance income. Then we receive the money at the end of the first year that you can directly take it from here. That's 363, the contractual cash flows collected. So we get a balance CD, that is balancing figure. First year ledger gets done. So 818,622, 98,235. This comes to 553,857. Let's also make the prepaid staff costs for a period of 1 year to begin with. So this is going to be bank. This is 81,378. So by profit and loss, 1/3 of this is amortized in the P&L, 27,126. So this comes to 54,252. 54,252. So this is the position of the ledgers at the end of the first year. Okay, I think now it's time to ask you, what do I do now? This is the normal accounting. We did the calculation of the fair value, identified the difference in transaction and the fair value. We made the ledger account at amortized cost approach. We did a straight line amortization of 1 year. Now tell me, what should I do? In the meantime, I'm just going to take the balance BD because the prepayments are made at the second year end, so this is 54252, and this is 553 857. So let's get your insights now. What am I supposed to do now at this particular stage? So what is the calculations which is required to be done? So first, I think we can definitely calculate a finance income at 12%. So 553, 857, 12%. That is 66, 463 rounded off. Okay, I am yet to get any inputs on that. That what am I supposed to do at this particular stage? I think in the meantime, let me do another entry as well. So we can look at the contractual cash flows, 339, that is collected. This is the status at the end of the second year. So we need to prepare a revised calculation table. That's right. So this is the book value on the date of repayment after accruing of interest and the collection of the contractual cash flow, but without considering the prepayment. Now, what do we need to do? Revisit on the fair value. So that's rightly said. So what we're going to do now, calculations on prepayment. So we'll do the calculations on the prepayment. Let's again go for a computation of fair value. Let's go for the computation of the fair value on the date of prepayment. So how do I calculate the prepayments in this case? Can I say the prepayments in this case is remaining contractual cash flows will be discounted. Now, we are very clearly given as far as the repayment of is concerned, the remaining collections will be left over. So we'll take year, we'll take amount, we'll take the PVIF, and we'll take the present value. So now we need to consider the remaining cash flows. Now we need to consider the remaining cash flows for the calculations. So let's make a mention. This amount is the remaining cash flows which needs to be discounted at 12%. So we've got another 1 year. We've got another 1 year to go. So there is a payment which is, I think now 2 lakhs principal. And the interest will be 5% on this. So at 12%, this comes to 0.893. So what we have done, we've just taken that if the prepayment occurs, then you will receive the 2 lakh rupees, because out of 3 lakhs, 1 lakh prepayment is done. So you're going to receive 2 lakhs at the end of the third year, another 1 year to go, and a 5% interest. So this 2,10,000 discounted at, this comes to 187,530. 187,530. Okay, so once the revised payment of the fair value is done, so this is like the revised fair value. On the repayment, this is like the revised fair value done. Now you need to compare the book value of the loan and the revised fair value and get the difference. So let's see what is the book value. Let's see what is the book value of the loan, and let's see what is the fair value, that is revised fair value. This is 187,530. That is the revised fair value which we got. Let's go back to the ledger and let's see the balancing figure at this stage. 553, 857, 66463 minus 339. It's coming to 281,320. This is the book value on the date of repayment. This is the book value on the date of repayment. So we get the difference between the two. We get the difference between the two. So 187,530, that's 93,790. The prepayment made is to the extent of 1 lakh. So can I say out of that 1 lakh, this gets adjusted in the liability, and where does the remaining get adjusted? So this gets adjusted. This is going to get adjusted in the loan. So out of this 1 lakh rupees, so the remaining amount, where does it get adjusted? 1 lakh minus 93,790. That's, I think, 6210. So where will you adjust the difference? This is adjusted against liability, that is loan. And where will you adjust the difference? 1 lakh was the prepayment, so we get this difference. Where are you going to adjust that difference? Can I say in the prepaid staff cost? Is the thoughts correct? So this is going to be adjusted against the staff cost, because out of the 1 lakh rupee, we need to make adjustments of 1 lakh. That 1 lakh indirectly has got a split. Okay, so I think now we can come back on the agenda. So let's come back out here. This is 93,790. So we receive 93,790 in the loan account. So I think now we can comfortably get the balance CD as a balancing figure. 553, 857, 66, 463. This is 187, 530, which of course you can match up with the fair value. The balance CD is nothing but the remaining fair value. So out of that 1 lakh rupee prepayment, we got what is adjusted out here, and we can also make adjustments out here. This is 27126, and then we put by bank. We got the figure. This is 6210. So we can get the balance CD as a balancing figure. 54, 252, 27126, 6210. This is 20916. Well, similar kind of questions have come in the exams. As I said, I think this kind of question came in July 21 also in the exam. So this is one special issue which there is a prepayment of a concession staff loan. I think that becomes an interesting question. Well, I think it's time to give you some break as well. But that was interesting. I think the core part of the standard gets done. The financial assets chain, the financial liabilities done. Now we need to discuss, quick agendas on the concept of derecognitions, on the concept of impairments, and on the concept of hedgings. We'll make some mind maps on these areas, I guess, after the break, friends. So any questions so far? Otherwise, let's, I think, take a 10-12 minutes break at this stage, and then we commence back. So we'll take a break, friends, 10-12 minutes. I'll join you back. So I had you have a relaxation of mind. I guess now let's come to some more special issues on 109. I think I'm going to start my discussion first of all with a quick mind map on the concept of impairment. Then I think let's discuss the concept of hedging. Let's make some mind maps because these are not very frequently tested, but of course, conceptually we need to be clear. So I'm going to first make some quick mind maps on the concept of impairment as well as hedging. And then we'll talk in terms of derecognition and we'll make some mind maps on that as well. So let's begin with the special issues now. So that's my mind map number 3 for the day. So this is the mind map number 3 where we're talking in terms of impairment of financial assets. Of course, liabilities do not get impaired. It's only that the financial assets gets impaired. Now, if you've taken the regular sessions, you would remember that here again we applied a simple 3-step model in terms of coming to the calculations that is called a loss allowance. So in terms of loss allowance, the first thing you need to see is that the asset in question, is it financial or non-financial in nature? Because there are two standards dealing with the concept of impairment. One is Index 36 and one is Index 109. So per se, when you're focusing on non-financial assets, it is 36. And when you're focusing on financial assets, it's 109. But then there are certain assets which have got an inbuilt impairment as well, because they do not need impairment testing. Like for example, inventory, where it is taken at cost NRV, whichever is less. Like for example, we've got biological assets which are taken at a fair value, less cost to sell. Deferred taxation, where the prudence is tested. So we can say 3 broad categories from an impairment perspective. So let's make a mind map 3-step model. So in the very first step, what you need to do, look at the nature of the assets. So we'll divide this in terms of 3 portions. So we can say all the assets from the impairment perspective can be segregated in terms of 3 broad categories. So either we can say they are financial assets, or we can say they are non-financial assets. They are non-financial assets. And the third is those assets where there is an inbuilt impairment. Those assets where there is an inbuilt impairment, and neither 36 nor 109 would apply. Now, per se, when you look at the concept of financial assets, they will be covered under Index 109. Non-financial assets, Index 36. And inbuilt impairment, like for example, inventory, Index 2. Like for example, deferred tax asset, Index 12. Like for example, agri-biological assets, which are covered under Index 41. Like for example, the plant assets, which are covered under Index 19. Like for example, non-current assets held for sale, they're also taken at a net fair value. So these are certain assets like inventory, DTA, biological assets other than bearer plant assets, NC held for sale, where impairment testing is not conducted. Now, once you say it is financial assets, it's important to also now segregate that these financial assets could be debt investments or they could be equity investments. If there are equity investments, the concept of impairment is not applicable. But if it is supposed to be a debt investment, it is applicable to amortized cost. It is applicable to FPT OCI recycling, but it is not applicable to FPTPL. They are not subject to impairment testing. I think that we've seen earlier in the charts as well. So this is your first focus, indirectly trying to understand that is the asset within the scope of this particular standard or not. So that is the first crucial step. So once you say, yes, I am in the scope of Ind AS 109, then it's time to go to the step number 2 after this. So let's go to the step number 2 now. So once we've identified the scope, then we go on to the step number 2. I think now the step number 2, of course, practically in a practical illustration, that assessment doesn't need to be made because that data is very clearly given in the question. But per se, we can say, when you're looking at step number 2, you are deciding between, you can say the approach. You're deciding in terms of the approach to make a loss allowance. And you know that there are 2 approaches. One is called a simplified approach. One is called a simplified approach, and the other one is called a journal approach. And I think the basic input, what we need to keep in mind is that simplified approach is basically used in terms of debtors if they've got no significant financing component. So when you look at a simplified approach, it typically applies, you can say, to trade receivable when there is no significant financing component. When there is no significant financing component, then in this particular case, the simplified approach applies. That means by virtue of the revenue standard Ind AS 115, you identify that these debtors are not containing any significant financing component, then a simplified approach is applied. In a simplified approach, just to recall, we basically use the concept of what is called a lifetime ECL. The concept of lifetime expected credit loss applies, which also means that there is no need to assess. There is no need to assess what we call SICR, that is significant increase in the credit risk. So because we're using by default the concept of a lifetime ECL in this case, the impact of whether the credit risk is significantly increased or not is not required to be assessed. And then comes the concept of a journal approach, where at the first instance we need to assess. We need to make an assessment that whether there is a significant increase in the credit risk or not. That's called the SICR, significant increase in the credit risk. If you say yes, there is a significant increase, then we use the concept of a lifetime ECL. And if you say no, then we use the concept of what is called a 12 months ECL. Now, what is basically you're going to derive after you identify that there is a significant increase in the credit risk. In this particular case, everything pertains to calculation of the probability of default. So this assessment that whether we're using a lifetime or a 12 months ECL will at the end of the day, you will be basically able to get, you can say the POD, that is the probability of default. So which is, of course, in a larger practical illustration always given to you that what is the POD? Like we remember the financial guarantee question. The probability of default was given 1% based on a 12 months ECL, 3% based on a 12 months ECL. So in any case, this assessment is only helpful in terms of deriving the probability of default, which in a practical illustration is given. But conceptually, we need to know all this. Okay, so this is the step number 2. Then comes the step number 3, the crucial and the main step. Then comes the step number 3, in which case it is now time to make allowance for ECL. It is time to make an allowance for ECL, that is expected credit loss. We need to make a provision for the expected credit loss, which has got a total of 4 parameters in terms of making a provision. You need to consider EAD, exposure at default, LGD, that is loss given default, into POD, probability of default, which you've already computed in step number 2. So we get the exposure at default, the loss given default, and the POD. And we also consider TVM, time value money, if it is relevant in nature. So the provision would involve a total of 4 factors in this case. This is nothing but the amount of the financial asset. This is the maximum loss which will occur if a default occurs. This is the probability of the default happening, and then the concept of time value money in terms of getting the results. You want me to do a quick question on this area on impairment? Then we can do that. Shall we do a quick question on the impairment aspect? I think I've not put a question on impairment as well, considering that this is pretty easy indeed. Yes, you want? Okay, then I think I'll probably just, show you a small little question on the screen. Just wait a second. I will share a small little question. Just give me a minute. Yes, I'll just share a question. Just a second. Something different. Maybe you've not done this. Let's have a look at this question. We'll apply the 3 steps on this. So maybe you can take a snapshot of this question. I'll just solve this out for impairment. Let's read the facts of the case. So we are given on 1st January X1. It says Nava purchased a bond 1 million, which is measured at amortized cost. The interest is 10% payable in arrears, and the repayment is due on December X3. It's a total of 3 years. And the EIR is also 10%. The contracted rate and the effective rate both are at the rate of 10%. Then he says on December X1, Nava received interest of 1 lakh rupee. It estimated that POD within the next 12 months is 0.5%. If the default occurs within the next 12 months, then Nava estimated that no further interest will be received and only 50% of the capital will be repaid. So we know what you are not going to receive. The asset's credit risk is low. If the asset's credit risk is low at the end of the year, that would mean a POD using a 12 months ECL. They'll discuss the accounting treatment on December X1. I think a few things initially to observe. It is undoubtedly a financial asset measured at AC, definitely within the scope of the standard. It's not a case of a trade receivable, so there will be a general approach. Considering that the credit risk is low, the significant increase in credit risk is not there. We're using a 12 months ECL, where the POD of 0.5% is given. So let's, I think, begin the journey. So I am just going to make a quick answer calculation to this. So let's see the answer to this question. Now, I would say the first instance is when you look at this kind of information, your focus should be to first of all, to highlight the input, you should calculate the amount of loan which you are not going to get converted in terms of present value. Consider all these three factors together. Consider all these three factors together. Calculate the amount which you will not get. When you multiply this, it tells you amount which you will not get. So this will tell you what you will not get. And when you consider this with reference to time value money, you get the amount. So POD can be taken later. First, just make a simple chart regarding the present value of the future collections which will not occur. So I'll make a column for year, and then the amounts, and then the PVIF, and then the present value. So let's pick up the data. So if I just go back on the inputs, let me just share it once again and we'll pick the data up. Now, the loan was given on January X1, 1 year is already passed. December X1, we received 1 lakh interest. Now it says it is estimated that if the default occurs in the next 12 months, you will get no further interest. So you're not going to receive interest for the second and third year. And 50% capital is repaid. That means you're not going to get 50% principal. So if I make a list of what you're not going to get, you will not receive the interest for the next 2 years. You will not receive the principal at the end of the second year. I would say at the end of another 2 years. So the interest is 1 lakh rupee. So I think let's make the calculations in this case. Starting on the balance sheet date, you will not receive interest after 1 year. You will not receive the interest after 2 years. You will not receive the principal, 50% principal after 2 years. I'm sitting on the balance sheet date and I'm saying I will not get the interest after 1 year. I'll not get the interest after another 2 years. I will not get 50% principal. So this is what I will not get. Discounting this at the rate of 10%, 0.909, 0.826. This is applying time value money. So let's see the calculations on this. So this is going to be 1 lakh into 0.909. That's 90,900. And this is going to be 6 lakhs into 0.826, 495,600. So if you take the sum total of this, that comes to 586,500. This is the total. Wow. So we get the present value of the amounts which we will not receive. But this is the full amount I will not receive. There is a certain probability of not getting this money. So now at this stage, you multiply this with the POD, and that is 0.5%, and we get the answer. As simple as that. So basically, you notice we first considered EAD into LGD. This means what you will not get discounted to time value money, and then multiply with the POD. So this comes to 586,500 at the rate of 0.5%. This is around 2,933. Right, so my special issue with reference to impairment is done. Now let's go to the next area of discussion, and that is hedging. So let's make a mind map number 4. So I'm making the next mind map, fourth mind map for the day. So mind map number 4. This is on the concept of hedging. So this is on hedging. So I think let's make a quick mind map on this, and I think we'll perhaps maybe do one question on this area as well. Now, when it comes to hedging, if you've seen the regular sessions, you would recall that instead of a 3-step model, here we've got a concept of a 5-step model, where you need to consider hedged item, then the hedging instrument, and then you need to consider the third factor, qualifying criteria. The fourth step is the type of hedge. And then the fifth step is the accounting for the various kinds of hedge. So let's document all these steps to you. So here we're going to create a 5-step model. So here we're going to create a 5-step model. So let's begin with the inputs in terms of step number 1. So the first thing what you need to do is to identify what is called hedged item. So let's recall the inputs, what is to be seen in terms of hedged item. When you consider the hedged item, it can be a recognized asset liability. It can be a, you can say, unrecognized asset and liability. So hedged item can be either a recognized asset and liability. It can be an recognized asset liability, or it can be an unrecognized asset and liability. Now, when you say that it is unrecognized asset liability, they are again of 2 categories. The first category, what we call, is a firm commitment. The first one is what we call a firm commitment, where the company has already entered into a binding contract. So when you've already entered into a binding contract, that becomes a firm commitment, or it is a highly probable, or it is supposed to be a highly probable forecasted transaction, or it is supposed to be a highly probable forecasted transaction that is unrecognized today. And I think let me also connect a few dots at this stage. Generally, when it is a case of firm commitment, we follow the concept of what is called a fair value hedge. And generally, when it is a case of a highly probable forecasted transaction, we use the concept of what is called a cash flow hedge. Sometimes the examiner may not give you the kind of hedge to be applied, then you can read in between the lines that if it is a firm commitment, it is a fair value hedge, and if it is supposed to be a forecasted transaction, then it's a cash flow hedge. So the hedged item is the list of all the recognized, unrecognized assets and liability. Then the step number 2. In terms of the step number 2, you need to get what is called a hedging instrument. You need to get what is called a hedging instrument. So basically the tool with which the protection is done. And in this particular case, generally when you carry out a hedge accounting, the derivatives are used for the purpose of hedging instrument. Forwards, futures, and options, they are the tools with which the hedging is done. And of course, hedging is something which is optional at the part of the company. So I think let's also make a inputs at this stage that this is completely optional on the part of the company. So that is the step number 2, getting the item and getting the instrument. Then comes the step number 3. In terms of the step number 3, you need to see the qualifying criteria. You need to see the qualifying criteria in this case. Just to give you a list of all those qualifying criteria. Your hedged items must be eligible. Your hedging instrument must be eligible. A formal documentation regarding the purpose of the hedging by the management should be clear, and we should see the hedge effectiveness as well. So mainly, you can say 4 parameters. You need to ensure that we have got a list of eligible hedged items. So we have got the list of eligible hedged items. We need to see that it is eligible hedging instruments. Generally, we make use of derivative contracts, though even non-derivative contracts can be used, but typically it is derivatives. And we need to make a formal documentation. We need to make a formal documentation as well, which outlines the purpose of carrying out the hedging. And we also need to ensure what is called a hedge effectiveness. We also need to ensure that the hedge effectiveness is there. And I guess I told you in the regular sessions that in terms of India's, there is no range within which a hedge effectiveness is seen. But generally, when you consider hedge ratio, if you go with the insights in US GAAP, it's around 90 to 125%. So in this particular case, if you go to the very basic inputs, using the US gaps as a base, the hedge ratio in this particular case ranges from a 90 to 125%. So to be an effective hedge, that should be the ratio. But generally, in a larger practical illustration, these parameters will, of course, be met. Then we go on to the step number 4. Where we need to see the type of hedge. And these instructions are very clearly given in the question. So we don't need to really bother in terms of the type of hedge. So it's either a case of a fair value hedge, or it is a case of what we call a cash flow hedge. So these are the two kinds of hedge, and which hedge is to be used in the management, that would be outlined very clearly in the question. But I think the crucial point is now the step number 5. And that is the accounting. So let's, I think, make this clear-cut chart that what is the accounting for the different types of hedge. Now, this is a crucial chart which will summarize the inputs in terms of a cash flow as well as in terms of a fair value hedge. Now, if I come to the inputs, in terms of the fair value hedge as well as the cash flow hedge, let's go one by one. So in terms of a fair value hedge, you've got the hedged item on one side, and you've got the hedging instrument on the other side. So you've got the hedged item on one side, and you've got the hedging instrument on the other side. Now, what you need to recall is the hedged item, the normal standards are not applicable. So if inventory is under the purview, we don't apply IS2. If PPE is the hedged item, we don't apply IS16. The normal standards are not applicable, but we need to apply the concept of fair value through P&L. Any changes in the fair value of the hedged item enters the P&L. Even in terms of hedging instrument, it is FPTPL. The derivative is accounted at a fair value through P&L. So any changes in the fair value is captured in the P&L. Now, quick question to you. Is there any kind of exception to this? I think let's get the insights from your side. Is there any kind of exception to this? When you consider a fair value hedge, the fair value changes of the item and the instrument are both taken in the profit and loss. But is there any exception to this, where the fair value changes are not taken in the profit and loss? That question goes to you. And that's rightly said. Wonderful. So the exception is if you've got equity investments which are measured at FPTOCI, there is no recycling. In this particular case, the fair value changes of the item and the instrument is taken in the other comprehensive income. So otherwise, the basic thumb rule is all the fair value changes goes in P&L, for the item also, for the instrument also. Equity investments is the only exception. Now let's talk in terms of the cash flow hedge, where we've got a hedged item as well as we've got a hedging instrument. So we've got a hedged item as well as a hedging instrument. Now here we need to be a bit more careful. So here we need to be a bit more careful in terms of a cash flow hedge. Hedged item, we apply normal standards. we apply the normal standards itself. Unlike unlike the case of a fair value hedge, where the normal standards are not applicable, in this case the normal standards apply. And in this particular case, we follow the concept of fair value. I'm not saying PLOC at the moment, we take fair value. But what is to be done is a crucial point. What is to be done is a very, very crucial point. You need to compare. You need to compare the fair value changes of the hedged item versus the hedging instrument. So we need to compare the fair value changes. Though this is not being taken at a fair value, but you need to compare the fair value change of the hedged item and the fair value changes of the instrument. And you would recall, that there will be two broad situations. One is if the fair value change of the instrument, if the fair value change of the instrument is less than equal to, if the fair value change of the instrument is less than equal to the fair value change of item, this is supposed to be an effective hedge. This is supposed to be an effective hedge, and everything, the fair value change goes to OCI. So when the fair value change of the derivative is less than equal to the fair value change of the item, the entire fair value change of the instrument is taken in OCI, and this is taken in cash flow hedge reserve in SOKI. It is taken in OCI, that is OCI-R, and it is taken in the SOKI, that is cash flow hedge reserve. And if you see the other way around, it is greater. If it is supposed to be greater, then in that particular case, if you say it is greater, then in this particular case, what do you do? To the extent of fair value change of item, this portion goes in OCI. So if the fair value change of the item is instrument is greater, then to the extent of the fair value change of the item goes in OCI, and we can say the remaining, whatever is the remaining change that is ineffective, that goes in P&L. That becomes ineffective portion, and that goes in the P&L. So you need to basically make a comparison in terms of the cash flow hedge. If the fair value change of the instrument is less than equal to the item, the entire fair value change of the instrument is taken in OCI. But if the fair value change of the derivative instrument is supposed to be greater, then in that particular case, to the extent of the fair value change of the item in the OCI, the remaining difference is ineffective in nature, that enters the P&L. Okay, so you want me to do a question maybe on a cash flow hedge? I think maybe we can, just do quick charts on D recognitions, I guess, because I think that we've extensively covered in the regular session. So if you want, I can spend a little time doing a question on the cash flow hedge. What do you desire? So if you think that's manageable, then I go to the next area of discussion. Or if you want me to do a quick question on cash flow, because fair value hedge is pretty simple, doesn't need much explanations. So what do you want me to do? You want me to do a question on a cash flow hedge or next area? No selections. I need your views on that. So next area of discussions or a quick question on a cash flow hedge. What do you desire? In the absence, I'll presume that we can go to the next area. So any choices? You want me to do a question on a cash flow hedge, or do you want me to go to the next area of discussions with you? A question on a cash flow hedge. Okay, that's great. So I think let's do that with you. I'll just share a small little question on that. Let me share a small question on this area. Okay, so let's have a look at this one. Question number 19 that deals with the cash flow hedge. Now, I am given, it says on 31st October X1, the company had inventories of gold which is costing 6.4 million to buy and which can be sold at 7.7 million. So that becomes the cost and that becomes 7.7, the fair value. The management is concerned about the risk of fluctuations in the future cash inflow from the sale of the gold. To mitigate the risk, the company entered into a futures contract on 31st October X1. It says to sell the gold for 7.7 million. The contracts mature on 31st March X2. The hedging relationship was designated and documented at inception as a cash flow hedge. All the effectiveness criteria is met. I think at this stage, I'd like to definitely pinpoint gold is the hedged item and the futures contract is the hedging instrument. And it is all the effectiveness is tested, so the qualifying criteria gets met. And it is a clear-cut case where it says it's a case of a cash flow hedge. Then he says at the end of the year, the fair value of the gold is given, and the fair value of the futures has gone down by 0.9 million. There is no change in the fair value of the gold and the futures contract between December and March X2. And then at the end of the year, the inventory is sold at a fair value, and it says the futures contract is settled with the bank net. Discuss the accounting treatment for the year ended December X1 and the treatment of the sale of inventory and the futures contract on March X2. So let's, I think, do this question on a chronological order. You can maybe take a snapshot of the screen, then I'll proceed further. Now, I would say when you're dealing with this kind of a question, you should get 3 focus points very clear on the basis of which you can solve the question. So, answer the question number 19. So I would say that there are a total of 3 focus points right now in this question. Let's organize the information based on the 3 data connects. There will always be 3 important dates on which the accounting needs to be seen in this particular case. One is, you can say, the date of contract. So what is the date of contract? When you entered into a futures contract, then what is the accounting? And I guess that date which I've given you is, I guess, on 31st October. This is 31st October. Then I think the balance sheet date gets important. That is on 31st December X1. And then you can say the settlement date that becomes important. Then it is the settlement date which is on 31st March X2 that becomes important. So when you're doing the accounting for a cash flow hedge, you need to keep the focus very clear that you need to consider 3 important inputs. One is the date when you enter the contract, then the balance sheet date in between, and then the settlement. So you can split your answer. You can split your answer into, I would say, 2 different parts. One is, you can see the accounting for the hedging instrument. One is you look at the accounting for the hedging instrument, and the other one is you start looking at the accounting for the hedged item. And this is undoubtedly, as we said, is a case of a cash flow hedge. This is a case of what we call a cash flow hedge. Now, as we move the focus, let's, I think, begin the inputs in terms of the hedged item. So can I say in this case, the gold being inventory, Index 2 applies. And if Index 2s apply, it will be carried at cost itself. So no accounting needs to be done. Because for the hedged item, we said the relevant standards would apply. Gold being an inventory, the normal standards would trigger. When it comes to the hedging instrument, in this case, you need to capture the fair value, and the fair value at initial recognition is always zero. Is always zero, because if you calculate the fair value at the inception, you do a squaring of the transaction at that day. When you square of the transaction, the fair value is always zero, so there will be no entry. So there will be no entry on this particular date. So your focus needs to be very clear. So this is what you do. You can say on this particular date. Now let's go further. On the balance sheet date now, on the balance sheet date, what you need to see, you need to compare the fair value change in the item, that is hedged item, and you need to see the fair value change in the derivative instrument. You need to compare, for the purpose of accounting, you need to compare the fair value change of the item and the fair value change of the instrument. I guess if I look at the data back, so the fair value change in terms of the inventory, that is item, it pushed from 7.7 million to 8.6 million. This was the fair value on 31st October, and this is the fair value which is there on 31st December. So the inventory in this case is increasing. That's a gain. I don't need to capture the gain. I don't need to capture the gain of the inventory. But we know that there is a fair value increase to the extent of 0.9. So this means that there is a gain. So here we are already given that there is a 0.9 loss. It's a very perfect hedge because the loss on the derivative instrument is exactly equal to the gain. Now, since these are equal, then it is an effective hedge, because we said that the fair value of the derivative instrument, the fair value change in the derivative instrument is supposed to be equal as compared to the item. It's an effective hedge. So what do? We take the entire amount in OCI. So the entry in this case will become OCI debit. OCI gets a debit, and the derivative financial liability gets a credit. In this particular case, the OCI gets a debit and the derivative financial liability gets a credit, and this is to the extent of 0.9. So this is the entry which is done on the balance sheet date for the instrument. The fair value change to be accounted depends upon the fair value change of the item. And in terms of the balance sheet date, here again we apply the concept of Index 2. The inventory will be taken at cost or NRV, whichever is less. The cost was 6.4 and the NRV is 8.6. So it will be continued to be measured at 6.4 million itself. No changes. The inventory continues to be the same. Next, now comes the date of settlement. Now on the date of settlement, he says the inventory is sold and there is a net settlement of the derivative contract. So let's first sell the inventory. So when you sell the inventory, you put the entry bank or debtors gets a debit and the sales gets a credit. So this is the entry for the sale of the inventory, and the inventory will be sold at a fair value. So we are given, I think first let me tell you, if you look at the fair value change in the item, and if you look at the fair value change in the instrument, so we are very clearly given the picture that there has been no change further. The question very clearly says that there has been no change. The fair value of the item and the fair value of the instrument did not undergo any change. If it did not undergo any change, in that particular case, no accounting entries. So the sale is going to take place at 8.6 million. The inventory of gold is sold at 8.6 million. We also capture the cost of sale. Cost of sale gets a debit and the inventory gets a credit, which is the cost of sale, 6.4. So this is the sale of inventory and capturing the cost of sales, that is the cost of goods sold. Inventory sold, but now we need to settle the derivative as well. if I need to settle the derivative, so this derivative financial liability will be settled. There is a cash settlement, so derivative financial liability gets a debit and the bank gets a credit, and the derivative financial liability 0.9 is settled. So as per the instructions, the derivative financial liability gets settled and the inventory is sold. Now tell me what else. Now tell me what else. This is the balance of OCI, which is accumulated in the tab number 3 of SOKI. So this amount, can I say, will go to the P&L once the hedge item enters the P&L. Since in this particular case, the inventory is sold and the hedged item is entered the P&L, now it is time to transfer the accumulated balance in OCI in the profit and loss. So we'll put another entry, and that is going to be profit and loss gets a debit, OCI gets a credit. This is 0.9. So this 0.9 is the accumulated balance in tab number 3, which is by the name of cash flow hedge reserve. Because this amount which is accumulated in OCI is nothing but it is called a cash flow hedge reserve. Once the hedge item enters the profit and loss, that accumulated balance in the OCI is transferred in the profit and loss account of the company. That was a beautiful question indeed, covering the aspects of hedge accounting as well. So we've covered the special issues with regard to impairments and with regard to the concept of hedging as well. Now, the only area which I didn't touch much upon, but I think I'll make a quick mind map on that, and that is derecognition of liabilities. Assets we've extensively covered. So I think I'm just going to make another mind map to you. So let's make a mind map number 5 for the day. So let's make a last mind map on liabilities so that everything remains at this place. Mind map number 5, that's on the concept of derecognition of financial liabilities. Assets we have extensively covered in the regular sessions as well. And most of the questions which comes is on a derecognition of financial liabilities. Okay, so let's make a quick mind map on this before we close financial instruments. So on the derecognition, here again, I give you the concept of what is called a 10% test. Because what kind of accounting would apply depends upon the 10% test. So we gave you a 3-step model out here. I gave you the concept of a 3-step model out here. So in terms of the 3-step model, number 1, number 2, and number 3. First of all, you need to consider the present value of the original cash flows at original discount rate. First of all, you need to consider the present value of original cash flows at the original discount rate. And then you need to consider the present value of the revised cash flows. You need to consider the present value of the revised cash flows at original discount rate. At the original discount rate. And in this case, you also add the element of transaction cost as well. And then you take the difference in percentage. Then you take a difference in terms of percentage, the difference between 2 minus 1 as a percentage of 1. And then you would recall, if this difference is 10% or more, would you like to tell me what accounting applies? If the difference is 10% or more, what accounting? And if it is less than 10%, then which accounting applies? That's rightly said. So here we apply the concept of what is called an extinguishment accounting, wherein you derecognize the financial liability and recognize the new financial liability. And here the concept of what is called a modification accounting applies. So this we have dealt again in quite a detail, the questions, but I thought, at least we'll make some quick mind maps on that. So once you conduct a 10% test, you get the results which kind of accounting would trigger in these particular cases. Right, friends. So I think we've tried to make the maximum possible of all the available time. I've tried to cover all the important aspects of financial instruments with you. Now it's time to put in your efforts as well. Consolidate your learnings, practice the questions, study material questions, revisionary test papers questions, mock test papers, and the questions which have come in the past examinations. Trust me, once you do all that, maybe not all the questions, but select few sample of questions, reuse it and have a look at them. Trust me, you get a complete hold on financial instruments. One of the most asked kind of questions in the exam. I think once you get a good grip on financial instruments, it covers a huge portion of your syllabus as well. Right, friends. So I think that brings me to the end of my inputs, unless you've got any questions at your end. Next session, that is on Sunday, we'll be starting with consolidation. We've got 4 sessions on Sunday. So starting from Sunday on consolidation, but we've got a lot to cover there as well. Our journey will start in terms of Index 103, moving to Index 110, Index 28, as well as Index 111. So lot more to go out there. Right, friends, over to you for any questions on your side. Okay, I think that seems to be all good. I guess no questions coming in. Right, friends, so time to bid you goodbye. I'll share the questions on the portal over here on that. So thank you very much. I'll see you in the next session. Thank you. Take care. Bye-bye. Thank you, G. Same to you.